I have been getting some great comments and questions from viewers lately, and I want to start addressing them with this video. One I got recently was quite long, so I'm going to break it down a bit because there actually is a lot to talk about when it comes to net income and SDE, or seller's discretionary earnings. I'll say up front, I am not an accountant. I'm a small business owner, and I also broker SBA loans, which are a type of financing that people use to buy businesses. I definitely recommend, if you're looking seriously at a business to buy, consulting with a firm that does quality of earnings reports and doing a really deep dive into the financials. So let's see what this viewer said. They said, in one of your previous videos, you mentioned that you brought in about 80K in net, parentheses, SDE cash last year, which seems to be very good as a percentage of the acquisition price. I have looked for laundromats up here in the Portland area, rarely come on the market, and the advertised return on investment is typically 15 to 20% or 22 to 30K net annual on an acquisition price of $150,000. So first off, I want to clarify that we have improved profitability of our laundromat since we first bought it. There was not an 80K SDE when we acquired it. What I really want to talk about is the difference between net income and SDE, or seller's discretionary earnings, because there are two different metrics and this viewer seems to be using them interchangeably, but the differences between them are important. Let's just start with a basic definition from Investopedia of what net income is. According to Investopedia, net income is what a business or individual makes after taxes, deductions, and other expenses are taken out. In business, net income is what a company has left after all expenses are subtracted, including taxes, wages, and the cost of goods. So to simplify it, net income is all of the revenue of a business minus all of the expenses. You get your net income. Taxes are where things can get a little more confusing because there are different types of taxes. In my work as an SBA loan broker, I look at a lot of P&Ls, or profit and loss statements. These are documents that show an overview of revenue and expenses. When it comes to taxes, payroll taxes are pretty much always showing up as an expense on the P&L. And you might see some other taxes depending on what type of business it is: sales tax, franchise tax, maybe a fuel tax. But I don't often see state and federal income taxes listed as an expense on a P&L. So when you're looking at a business to buy, what's really important with both net income and SDE is that you understand how the seller arrived at this number, because I do see people calculating these numbers a little bit differently. If someone tells you they have a 30K net income, you should definitely look at a profit and loss statement and get verification of the revenue and expenses to understand how they arrived at that number. Now, SDE, or seller's discretionary earnings, is sometimes used interchangeably with net income, but they are actually two different things, and the differences between them is pretty important. Essentially, SDE is a way to more accurately compare two businesses and to give a potential buyer a more accurate idea of what the finances would look like when they acquire the business. If you're comparing two businesses, SDE is really what you want to get to. I'll explain why in a minute and also give some examples. SDE is similar to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. In other words, how much money a business is making after we subtract the standard operating costs, but before we subtract interest, taxes, depreciation, and amortization. The difference between SDE and EBITDA is that SDE is also adding back the owner's salary if they're taking one, but SDE is more commonly used with smaller businesses, so that's what I'm going to focus on. What a lot of this comes down to is taxes. As a business owner, there are a lot of things that you can legally write off to reduce your taxable income. Some of these expenses are pretty straightforward. I paid for utilities and wages and supplies in order to operate my business, and I can write off those expenses. Then there are non-cash expenses like amortization and depreciation. And you might be thinking, well, if it's an expense, how can it be non-cash? Does that mean you paid for it with a credit card? No, it means I did not actually directly pay that amount in the month it was recorded on my P&L. Depreciation and amortization are ways to spread the cost of tangible and intangible assets of a business out over time. An example of a tangible asset would be a piece of equipment, and an example of an intangible asset would be something like goodwill. Let me give you an example. Let's take a look at my actual profit and loss statement from December of 2023. As you can see, there are some relatively large expenses for depreciation and amortization. Let's focus on this depreciation expense for about $9,400. This is for an equipment purchase I made for 2 new washers. Now, I didn't actually spend $9,400 that month on those 2 new washers. In fact, I didn't spend any money that month at all in those washers. I have an equipment loan with a small monthly payment. Those payments didn't actually even start until a couple months later. However, I am legally allowed to write off a portion of the cost of the equipment every year on my taxes, thereby reducing the net income on my profit and loss statement and on my taxes. So as you can see, my net income looks terrible for this month. It looks like I lost $10,000, but that's because of these non-cash expenses. Here's where SDE comes in with something called add backs. Add backs refer to adding back in certain expenses in order to make it easier to compare the earnings of one business with the earnings of another. So with SDE, you can add back interest, taxes, depreciation, amortization, the owner's salary if they're taking one, as well as some one-time expenses and discretionary spending, as long as it doesn't actually relate to the operations of the business or it's not required for the business to continue operating as is. Let's say you're comparing 2 businesses that you're thinking about buying. And for the sake of making things simple, I'm going to use really easy numbers. Let's say that both business A and business B are grossing $20,000 a month, and they both have $15,000 in standard operating costs. But business B also has a $1,000 interest payment that they're making each month, whether it's for the loan they use to buy the business or an equipment purchase or something else. So business A would be showing a higher net income because business B has that interest expense. But most of the time when you buy a business, you're buying it debt-free. So that interest payment wouldn't apply to the new owner. So if you were just looking at the net income of these 2 businesses, it would make it seem like business A will make you more money when in actuality, they would make you the same amount of money. That's why typically the value of a business is based on the SDE, because the net income isn't necessarily going to give you the most accurate idea of a business's earnings because of these non-cash expenses and because there could be expenses included that wouldn't apply to the new owner. Of course, it's never actually as simple as the example I gave, and you definitely need to look into that SDE number and make sure you understand how the seller got there. Ideally, they should be providing you with a spreadsheet that shows all of their revenue, all of their expenses, and the things that they're adding back to get to that SDE number. Add backs can sometimes get messy, so it's important to look at them carefully. Basically, anything that is required to run the business and is going to recur, whether that's on a weekly, monthly, or even annual basis, cannot be added back. Adding back interest, taxes, depreciation, and amortization is usually pretty straightforward. One-time expenses and discretionary spending can get a little more complicated. Let's say, for example, a seller is adding back a one-time fee they paid to a consultant. You would want to make sure that really was a one-time fee and not something that the business is going to need again, even if it only needs it once a year, you should only add things back if they really were a one-off expense that the new owner won't need to do again. So for example, I had a new folding table installed last year. That's not something that a new owner will ever need to do again. That table is there and it's good to go. So I added that back into my SDE calculation because it really was a one-time expense. By adding that expense back, my SDE more accurately represents what a typical year of owning this business is like. Or maybe the seller has been running some personal expenses through their business. I'm not saying this is something people should do, but a lot of small business owners do this. And so maybe they're adding back expenses that were really personal expenses they didn't actually have to do with the business. So those could be legitimate add backs, but you just want to make sure that you can actually verify those expenses and verify that they don't have anything to do with the operations of the business. I hope this video was helpful to you. I know this topic can get complicated, so please let me know your questions in the comments and let me know any other questions you have about buying or operating a laundromat or small business in general. Thanks for watching.